In this video, I'm going to tell you how you can save $100,000 for emergencies, college, retirement, a new car, dream vacations, and much more.
Please let there be money in our bank account. Amen.
Amen.
For many of us, spending comes naturally. Saving, however, can take a little practice. This video offers practical advice on how and where you can save money for your goals. So, let's get right into it. The first saving goal for most individuals and families should be an emergency fund large enough to handle serious, unexpected expenses, such as a costly car repair or a medical bill, or both at the same time. An emergency fund can also tide you over for a while if you lose your job and need to hunt for a new one. Financial planners commonly recommend setting aside at least 3 months of living expenses. Some suggest 6 months or even a year. In the case of retirees, some planners advise keeping 2 years' worth of living expenses in an emergency account to avoid the risk of having to cash in stocks or other volatile investments in a bear market. Unless you're already a big-time saver, your take-home pay is a fair approximation of your monthly living expenses, and it's easily found on your pay stubs or bank statements. So that you can get to your money quickly in an emergency, the best place to keep it is in a liquid account, such as a checking, savings, or money market account at a bank or credit union, or a money market fund at a mutual fund company or brokerage firm. If the account earns a little interest, all the better. In most cases, these kinds of accounts will allow you to write a check, pay a bill online or with an app on your phone, or move money by electronic wire transfer from your account to someone else's. If they provide you with a debit card, you'll be able to withdraw cash from an ATM. To fund your account, consider using all or part of the money that comes your way outside of your usual paycheck. That might be a tax refund, a bonus at work, or income from a side gig. If you receive a raise, try to contribute at least a portion of that to your account as well. Another time-honored tip is to pay yourself first. That means treating your savings like another bill and earmarking a certain percentage of every paycheck to go into it. To avoid the temptation of simply spending the money, you can often arrange for it to be deposited directly into the account by your employer, or else deposited into your everyday checking account and then automatically transferred from there to your emergency fund. Of course, saving even 3 to 6 months worth of expenses is easier said than done for many of us. But even if it takes a while, it's a goal worth working toward, both for financial security and peace of mind. One last thing. If you ever need to take money out of your emergency fund, try to replenish the account as soon as possible. Now, let's talk about saving money for retirement and financial freedom. Retirement is the single largest savings goal for many of us, and the challenge can be daunting. Fortunately, there are several smart ways to set aside money, many of them with tax advantages as an added incentive. Those include 401k plans for private sector employees, 403b plans for employees of schools and nonprofits, and individual retirement accounts, IRAs, for just about anybody. The easiest, most automatic way to save for retirement is through an employer plan, such as a 401k.
It's really like running a marathon more than a sprint, and you have to know where you want to go.
The money comes out of your paycheck automatically and goes into whatever mutual funds or other investments you've chosen. You don't have to pay income tax on that money, or on the interest or dividends it earns, until you eventually take it out. As of 2020, you can put as much as $19,500 a year into a 401k plan.
11, 12, 13.
As still another incentive, many employees will match your contributions up to a certain level. If your employer kicks in another 50%, for example, an investment of $10,000 on your part will actually be worth $15,000. But what if you want to save money for college? Don't worry. Just like retirement, the easiest way to save for it is automatically, in this case through a 529 plan. Each state has its own 529 plan, sometimes several. You don't have to use your own state's plan, but you'll generally get a tax break if you do. Some states allow you to deduct your 529 plan contributions up to certain limits on your state income taxes and won't tax the money you take out of your plan as long as you use it for qualified education expenses, such as college tuition and housing. The federal government doesn't offer any tax break for the money you put in, but, like the states, won't tax the money you take out as long as it goes toward qualified expenses. So, how to save money for college and retirement? Most of us are likely to have more than one savings goal at any given time, and a limited amount of money to divide among them. If you find yourself saving for retirement and a child's college at the same time, one option is to consider a Roth IRA. Unlike traditional IRAs, Roth IRAs let you withdraw your contributions but not any earnings on them at any time without tax penalties. So you can use a Roth IRA to save for retirement, and if you come up short when college bills arrive, tap into the account to pay them. The downside, of course, is that you'll have that much less money saved for retirement when you may need it all the more. But what if you need to save more money than you can easily pry out of your paycheck? Here are some ideas often suggested by financial planners. Get a handle on your spending. For a period of time, a week, a month, or whatever you can stand, try to record absolutely everything you spend money on. You can either use an old school notebook or an expense tracking app, such as Clarity Money or Wally. People often find they're frittering away funds on things they don't need and could easily live without. Some apps will even do a bit of savings for you. The Acorns app, for example, links to your debit or credit card, rounds up the purchases to the next dollar, and moves the difference into an investment account. Get cash back on your purchases.
Remember, a penny saved is a penny earned.
As long as you are buying things you truly need, it makes sense to sign up for apps such as Rakuten or Ibotta, which offers cash back for retailers or groceries, clothing, beauty supplies, and other items. Or you can use a Cash Rewards credit card, which offers 1 to 6% in cash on each transaction. Chase Freedom, for example, offers 5% cashback rewards on categories that change periodically. Of course, this tactic works only if you transfer your savings to a savings account and always pay your credit card bill in full every month. Focus on major expenses. Clipping coupons is fine, but you'll save the most money by paring back on the biggest bills in your life. For most of us, that's things like housing, insurance, and commuting costs. If you have a mortgage, could you save by refinancing it at a lower rate? With insurance, could you shop around for lower premiums or bundle all your policies with one carrier in return for a discount? If you drive to work, is there a cheaper alternative, such as carpooling or working from home one day a week? But don't go crazy. You might want to dine out less often, try to get a few more wearings out of your wardrobe, or drive the old car for another year. But unless you enjoy living like a miser, and some people actually do, don't deny yourself every last pleasure in life. The point of saving money is to build toward a financially secure future, not to make yourself miserable in the here and now. And that's it, guys. If you like this video, don't forget to like and subscribe. Till next time.